All right, so let's break down this powerful chart. At its core, this is a roadmap of market manipulation leading to a clear profit opportunity. The whole sequence begins during a period of high volatility, where the big players are actively shaking out both the bulls and the bears. This creates an intense battle, reflected in the bulls' power and bears' power indicators, and often sweeps the market for liquidity, hunting for the stop losses of trapped traders. The key signal to watch for is a breakout, BO, from this chaotic phase, specifically a breakout above a key structure. Your entry is confirmed there, with your trade's risk management defined by a stop below the nearest demand zone, which is the area that now represents a new foundation of support after the manipulation is complete. Now, if we zoom in on that manipulation phase, we see it's not random. It's a calculated liquidity hunt. The price is being driven specifically towards a breaker block zone. Think of this as a wall of pending orders that the large institutions want to trigger. They're targeting several types of liquidity pools: external LQ beyond recent highs or lows, minor LQ at smaller swing points, internal LQ within the range, and interval LQ around key levels. The critical thing to understand is that every significant structure, every high and low, becomes a good target to take partial profits. Why? Because when price sweeps these levels to hunt for stops, it's likely to reverse sharply. So securing profit at these predefined structures is how you lock in gains and manage the trade like a professional. Flip the script and look at the exact same concept from the sell side, at a supply zone. This is where the previous uptrend meets its match. We identify a key area where we see a clear imbalance, a massive wave of selling just waiting to enter. The trigger for our sell entry is a two-step process. First, price must sweep the liquidity above the recent high, trapping the last of the bullish traders. Then we need confirmation. The first structure to the downside must break. A key signal to watch for here is a change of character, CHoCH, a specific shift in market structure that signals the strong buy power is exhausted and strong sell power is taking over. This is the creation of a smart money concept, SMC supply zone. Just like on the buy side, you manage this trade by taking partial profits at the next significant structure below as price moves in your favor. Synthesize everything into one powerful high-probability sequence, the liquidity inducement setup. The core premise here is simple. We are identifying a moment where the seller becomes stronger than the buyer. It all starts at a key supply zone. The market doesn't just reverse here immediately. First, it performs a liquidity sweep above that zone. This is the inducement. It tricks bullish traders into entering, creating a pool of stops for the smart money to hunt. Once that liquidity is taken, price rejects hard and gets trapped in a low range, indicating a battle where sellers are now dominant. Our confirmation comes with a change of character, CHoCH, to the downside, and then the breakdown of multiple structures. This is your signal to enter. As the trade plays out, you take partial profits at your targets. But here's the advanced part. Don't be surprised if price pulls back to fill the orders at the original breaker or supply zone. This is the backing and filling of institutional orders. Once that's done, price typically continues in the intended direction, allowing you to take your full profit. This is the complete cycle of how smart money manipulates retail to move the market and where you can step in to profit from their game plan. Now, to truly master these setups, you need to understand the hierarchy of liquidity, specifically the move from internal to external liquidity. This is the engine behind every major price move. Internal liquidity refers to those stop losses sitting just inside the recent range, below a low or above a high. The market often takes these out first with a quick sweep, but that's just the warm-up. The real target is the external liquidity, the major pools of orders beyond significant swing highs or lows that have been left untouched for a longer period. The sequence is key. Price will often sweep the internal liquidity, run into a key structure like a breaker or order block, and then use that momentum to make a powerful push to sweep the far more significant external liquidity. This is where the big moves happen. For us as traders, this tells us exactly where to look for reversal zones and, crucially, how to manage our risk. Your stop loss should always be placed below or above for a sell, the most recent significant liquidity sweep. Because if that level is taken out, it means the market is likely going for the next external target, and your original thesis is invalid. This entire process of hunting liquidity and shifting power brings us to the foundational market cycle, starting with accumulation. This is the quiet phase where smart money builds their positions. On the chart, we identify this by spotting a liquidity structure. It often begins with a sign of seller strength, SSS, a final push down that sweeps out the last of the bullish liquidity. You'll see multiple LQ, sweeps as the market hunts for every available stop loss below a key level. But then, the momentum stalls. The most critical signal appears, a change of character, CHoCH. This is the first higher high that breaks the previous downtrend structure, telling us the sellers are no longer in control. This shift creates a new demand area, a zone where price respected and rallied from. This is your high-probability buy zone. Accumulation is all about recognizing this transition from a downtrend into a new basing pattern, where the stage is being set for the next major move-up. And this brings us to the most important takeaway. Liquidity moves the market. Every major price swing is essentially a move from one pool of liquidity to another. Our job is to anticipate these moves and position ourselves to profit. Look at this sequence. After a downtrend, the market identifies a key demand area. But before it reverses, it often makes one final sweep down. Hunting for the remaining stops below that level, this is the liquidity, LQ, to catch. This sweep creates a springboard. We then get our confirmation, a break of structure, BOS, to the upside, a change of character, CHoCH, and a strong buying impulse. This shift in momentum turns the old liquidity sweeps and imbalances into our profit structures, the levels we target to take gains as the new trend unfolds. So remember, you don't just buy a demand zone. You buy the confirmed move after the liquidity below it has been hunted, signaling that the path of least resistance is now up. Now let's look at one of the most aggressive and rewarding setups, the extreme supply entry. This isn't just any supply zone. This is a level where the imbalance between sellers and buyers is so extreme that the move can be swift and powerful. The sequence is precise. First, price makes one final, often exaggerated liquidity sweep, LQ sweep high, clearing out all the remaining bullish stops. It then reverses sharply and fills the fair value gap or imbalance it just created with force. Our trigger for entry is a decisive break of structure, BOS, to the downside, confirming that the sellers are now in absolute control. This is your signal to enter the trade. Because this is such a strong move, your risk to reward can be exceptional. You manage it by taking partial profits at the next clear market structure below, while letting the rest of your position run to capture the bulk of the move. This extreme setup perfectly encapsulates the entire smart money concept. Identify the liquidity hunt, wait for the structural confirmation, and then step in to ride the wave of institutional order flow. To tie all of this together, let's end with the most critical lesson: the difference between a good entry and a bad entry. A bad entry is often rushed. It's busy, and occurs right at a demand zone before the market has swept the crucial liquidity below it. This is extremely risky, because if that sweep happens, your stop loss is vulnerable. The right entry, however, requires patience. You wait for the market to do its job. First, it performs the sweep of the liquidity below demand. Then it moves back up to close the imbalance it created. Only then, on a subsequent break of structure, BOS back in your favor, do you enter. This disciplined approach transforms your risk. Your stop is safely placed below the demand and the swept liquidity, and your profit potential is maximized. Instead of one target, you can take profit at structure on the way up, securing multiple wins from a single, high-probability setup, ultimately aiming for a significant 6x reward or more. This isn't just trading. It's trading with the flow of the market. And for the advanced traders looking to maximize their efficiency, let's break down the powerful double trade concept. This strategy allows you to potentially profit from the same key level twice, but in opposite directions. It starts with identifying a strong demand area. The first trade is a standard buy, as we've discussed, after a sweep and a BOS to the upside, with a stop loss below the demand. But here's the advanced move. As price rallies, you take your profit at the next structure. Now watch closely. If price makes a strong move up and then reverses back to fill the imbalance it created on the way up, that same demand zone can be tested again. However, if price breaks down through it with a new BOS, the character has changed. This demand zone has now turned into a supply zone. This is your signal for the second trade, a sell entry. You place your new stop above the former demand area. As price falls, you take partial profits at structures below, effectively getting X2 the opportunity from one key market level by dynamically reading the shift in market structure and order flow.